Good for Terry, CEO of IMARKETSLIVE, and I want to discuss the conditions of what we see here on Sunday night. So first off, the market closed right here on Friday, and the market opened right here on Sunday. This means that during the weekend, there was some kind of news that caused the market to change. I personally am not interested, or I really don't care anything about the news. I really don't. It's never been important to me. I can care what Brexit did. I can care less if the euro went up. I don't care. All right. I'm a technical trader. That's all I care about. And what I do is react or act after the news has occurred. Now, sometimes you can expect news in advance, whether it's non-farm payrolls, FOMC, which is the Federal Open Market Committee, making changes of interest rates, or whatever it may be on a global basis. We see all that. But when there's unexpected news, this causes a shock to the market. As you see, the market opened here after closing here, and you have a lot of people, and you can look at them on Facebook. Everybody knew the move in advance, of course. Okay, I've never traded that way. It's not important to me. All I want to know is, where is the current market? Where did it open? And what do I do with that information? All right. Now, the best thing that I could suggest is what I've always done is the market. Let me explain this to you. The first 30 minutes of the day, right here, it's a 30-minute bar. Okay. The first 30 minutes of the day is what they call the initial balance. Okay, your initial balance. And what happens during the course of a trading day, let me explain. Let me see if I could bring this down to maybe a 5-minute chart, okay? All right, so we take that 5-minute chart, and what we see here is 5, 10, 15, 20, 25, 30. Okay, so we see here that this area right here was what we call the initial balance for the day. This marks a high and marks a low after the first 30 minutes. After a large gap, up or down, after a large gap, the market takes about 30 minutes to settle out, and then we look at determining the direction for the rest of the day. Some traders look at the first hour. There's no right or wrong about it. You can use the first 30 minutes or the first hour of the day to determine. What we like to do as professional traders is you mark off the high and you mark off the low after the first 30 minutes. Now, like I said, some people like doing 60, some people like doing 30. 30 is typically what they call, like I said, the initial balance in what's called market profile. So after the first 30 minutes of trading, you establish that market profile, high or low, and then we take it from there. The fact is, the market has been shocked, okay? And after the first 30 minutes, we want to either sell a breakdown from the low of the day or buy a breakout of the high. So if you're to sell, for this example, if you sell the low of the day on a breakdown, your risk goes to the opposite side of the bar. It doesn't matter the size of the gap if your account can sustain it. So let's just say you want to do a 3% risk ratio, and I know some of you people do a lot larger and some do lower. It doesn't matter, but let's just say 3%. You'll look at the pip difference of what you have here, and then you divide it up and you come out with a 3% risk and a trade size that you're going to use. I'm not going to get into that. We have too many videos on that. My goal right here is to establish a foundation for when you move forward into the future, that if you ever occur this again, you know what to do. It's me giving you another little bullet to put in your holster. That way, if you ever see this condition again, which you will, I'm sure, there are so many markets. There's stocks, there's commodities, there's bonds, there's S&P futures, there's European index, there's foreign exchange markets. There's so many different markets out there that you can apply this to. And this is just one example. And I've been doing this for so many years. I know how to take action, and I know how to tell you what to do to protect you. So You wait for the first 30 minutes, you sell the low on a breakdown, you put your risk at the high, and from that point, the market should establish a direction. The main thing is the prior range high, where the market broke from, is called the gap close. Here, this is also called a gap close. There's two ways to look at it. You can look at the prior high on the market, and the markets more or less attract to the prior swing high. In this case, this is the prior swing high. I don't need to give you 100 different examples. One example is perfect, and if you understand the perfect example, then you've got the game beat, okay? There's never going to be a perfect example. The main thing is you just want to get the direction correct, and once you get the direction correct, all else is easier. As the markets move in your favor, you want to peel off positions, which means you want to exit partials on the way down and move your stop to basically an even position. That way, if the market comes back up, you don't lose. And you want to continue to trail the market. Once you break out the first half hour or hour, depending on what you like, I like the first 30 minutes. Once you determine that direction, that gives you the main trend for the day. It could be going forward. You just want to see how far it goes. You should not have to worry about the market coming back against you. And from that point, you then start looking at prior swing highs, gap closes. This is also a gap close. There's two types of gaps, which means that the market at a high, it closed here, the market opened. This would be a gap close, and this is also a gap. One's called a lap, one's called a gap. It's pretty much the same thing. Professional traders like to look at prior swing highs and prior swing lows. Most important part of your chart is that. All right. Once the market breaks down from that range, you then want to bring a break-even stop and just let the market play itself out. Okay, and look to play for the gap close. I hope this video made sense to you. I didn't think it was relevant to put any kind of trade out today, but I thought an educational video would help you understand how to trade gaps into the future, and that if we ever see it again, you know what you need to do. Take the first 30 minutes of trading, take the range high, the range low, and you sell a breakdown or you sell a breakout up. Now, if I was looking at this and say, okay, how many pips are involved? So let's just say from here to here, you have 40 pips, hypothetically. Okay? So 40 pips, you do your math, depending on how your account size is, and then you come up with your risk ratios. Very simple. For instance, one mini would be 40 pips, $40. $40 on $1,000 is 4%. So $1,000 account on 40 pips on one mini, that's 4% risk. Let's just say you want to do half of that. You use 5 micros. Let's just say you want to be more aggressive. You do a mini and a half, mini and 5 micros. So keep it simple. It's KISS. Keep it simple, stupid. And that's me. I like to call myself stupid sometimes. Anyway, listen, we're all professionals here. We're all in this game together. We're all here to succeed. And my job as CEO of the company is always to find things that are important and bring them to the table for you, not to sit and put you in positions and trades that will not make sense. My job is to protect you. You'll see a lot of times maybe the swipe trades, Justin won't trade, or maybe the fusion or FX signals live, or maybe there's no calls on the daily swing trades. That's because I'm in the background saying, listen, guys, be careful. Or maybe in the live IML rooms, be careful, because it's a holiday, because of volume. Always important. Respect volume. Respect the day before, respect the day after a holiday. All right? What we saw here today, that gap up, it changes the whole game, and everything changes, and that's the nature of the beast. You just have to know how to react to an action that has occurred. Anyway, we spent about 10 minutes babbling. I hope this has helped you. please share it with everyone you know, because it's real important how to handle gaps in the future, not only in the Forex market, but in the stock market, but in the commodities market, but in the futures market, the bonds market, or any other markets that you watch. I watch gold, we watch everything, oils, and that's most important. You could test it out, you could look at it. Another game we like to look at, I'll give you a couple examples, is over the past, for instance, you take the past 1, 2, 3, 4, 5, 6, 7 days, right? Take 7 days, and you look for a day where it's the narrowest range over the past 7 days, and we look for breakouts up or down from that. So there's little codes and indicators that I have. I may be sharing them in the future of all sorts of little models that we could work with in the future. But for now, gap, breakout, how to handle them. My name is Christopher Terry. Have yourself an amazing week.